Okay, good morning. My name is Dean Christians. I want to thank everyone for being here today. Hope everyone had a prosperous 2024, and here's to even more prosperous 2025. As always, I'm joined by my fellow research analyst, Jay Kaeppel, and today we're going to dig into some of the most pressing topics that at the top of my mind right now. So let's hop in and get started. Okay, so I'm going to just sort of start with sort of the big picture here. Over the last month and really 6 months or a year, the sort of topic du jour here has been, this concentration that we've seen. And here, just last December, we saw the top 10 stocks in the S&P 500 bump up to, almost 40% of the weighting in that index. And that's a significant amount. And if we look at this chart here that provided by Ned Davis Research, we obviously see that's a new record high in terms of this concentration. And so what I wanted to do today is really just sort of address, the implications of this concentration, really in two ways. One, and what does it do to market breadth? And then obviously, what does it do to sort of attribution statistics in terms of, performance within the index? And as you can see in this chart, there are a lot of, for most investors, unless you've been in this business for 50, 60, 70 years, this is unusual. But there is a precedent. If you go back into the 50s, 60s, and 70s, you had high concentration within the S&P 500. So while for current day investors this is unusual, it's not if you look at sort of the big picture market history. So let's jump over to our next slide and take a look at some of what this means for market breadth, and then in terms of performance metrics. Just a comparison here. You can see top 5 stocks here. This is a great chart by Jim Bianco, but top 5 stocks here now almost 29%, and then you can see back in 1964 they got up to almost 28%. So there is a precedent for this sort of concentration in the marketplace. It's just that it hasn't happened in a very long time. All right, so what does it mean in terms of market breadth? Well, what we see is these real oddities. This is sort of a term that Jason likes to use. And if you follow us on Twitter, a lot of times we'll mention these breadth oddities, but I thought this was a great chart, that just to sort of highlight what we've seen here of late. And what we can see is in December of 2024, you had 14 consecutive days where there were more declining issues in the S&P 500 versus advancing issues, okay? And that has never, ever happened in history when the S&P 500 was down less than 4%. The only other time it's happened, in 1978, the S&P at that point was down almost 13%. So you were in a correction. For me, anything down less than 5% is just a consolidation. So highly unusual event here. If you look at 10 straight, less than 4%, that only occurred 4 other times in history. 3 of those was, between 66 and 72, back when we had, higher concentration in terms of the top 5 or 10% of the stocks in the S&P 500. So, these breadth oddities are popping up more frequently. And I think it's just good to be aware of it, that, it may be here to stay, at least for the foreseeable future. Another great chart, which I've, shared with subscribers over the years, is this, the percentage of S&P 500 stocks outperforming the index over a rolling 21-day period. And what you see here is these wild gyrations that really kind of started COVID. And this is when we saw this concentration really take off. So, right now, we're at 40% of the S&P in the top 10 stocks, that weighting. And we also had 2 of the lowest readings ever in terms of they got down to roughly, 14, 15% of the members outperforming. These wild gyrations here of late is a consequence of this heavy concentration towards the top of the S&P 500. You can see it when these stocks are in gear, the rest of the market's out of gear, and you get these sort of wild gyrations or breadth distortions. If you look back here between sort of 52 and 82, you see a lot of these wild swings that took place. And this just goes back to this period being a period when you had high concentration. If you look at like in 1963, you know, American Telephone was 11% of the S&P 425 index. Now, keep in mind, back in this time frame, the S&P was comprised of an S&P 425 industrial index. Then you had rails and you had utilities. That was it. Then they started to break it out in individual sectors. Within that industrial 425, you know, you had energy stocks, you had consumer discretionary stocks. It's just they didn't break it out. I just wanted to highlight here too. First index fund was created in 1976. So this is not unprecedented, these wild swings, these breadth distortions, but this is something that investors really haven't seen in quite a while. Okay, let's move forward here. This is a great chart by Ed Yardeni. This one's showing percentage of S&P 500 companies outperforming the index on a year-over-year basis. What you can see, this has got down to very low levels here, sort of this post-COVID era. You saw that also occur, you know, leading into the 2000 top. And this has been trending down since, it's tough to say, but 2001, 2002, into a new low. So this is just something to consider moving forward. Okay, so let's just talk about fund flows. And so here's the thing. Don't rule out that the concentration gets more extreme down the road, okay? So the simple fact is the market right now is geared towards passive assets, right? And passive assets is just simply somebody allocating to the S&P 500, and be it an index fund or an ETF. They could be doing that in an IRA. They could be doing that in a 401k plan. But last year you had a record amount of money, $1.12 trillion flow into ETFs. That was a new record. And more importantly, passive assets have overtaken active assets. Okay, so we've had this structural shift of, you know, movement more towards passive, and that has, you know, consequences for sort of the market environment, the market structure. Again, here we can see largest ETF flows in 2024, dominated by the S&P 500 ETFs. You know, you can see the top one, Vanguard, pulled in $117 billion in 2024. It now has net assets of almost 600 billion. If you total up all these ETFs, you got like 1.5 trillion. And that's just ETFs. If you probably include in the index funds, you're talking about $2-3 trillion that are simply in the S&P 500, where currently 40 cents on every dollar that flows into the S&P 500 is going to the top 10 stocks. And if you look at the Mag 7, which is just over 30%, that means that 30 cents on every dollar is flowing into 7 stocks. So something that's it's unusual for investors in today's landscape over the last 2, 3, 4 decades. And it's probably here to stay for the time being. When you look at the weightings, consumer discretionary, communications, technology, this sort of digital economy, it's like 53% now. And remember, these people that are putting money into the S&P 500 don't care about fundamentals. It's really just a portfolio allocation bet, a set it and forget it type of strategy. Okay? All right. Here, this is what's crazy is going back to the fund flows is just all this financial innovation, how it's really geared towards the S&P 500 and growth stocks. And you can see this. There's a Mag 7 ETF. It pulled in $800 million in the month of December alone, okay? And then that's when we saw the tech stocks take off, right? And then we saw everything else start to underperform. And as I mentioned earlier, when we had that drop in the percentage of stocks outperforming the S&P 500, you know, we got down to the second lowest level ever. Well, it was because money was flowing into the S&P 500 and ETFs like this. Financial innovation. Look at this. We have these levered ETFs and single stocks, 200% leverage. Well, look at the list. Everything is towards tech and growth with the exception of Berkshire Hathaway. So the system right now is structured to flow towards growth-oriented stocks and sectors, okay? Will that change down the future? I don't know. Maybe, yes, who knows? We'll take a look. But as it stands right now, we have to keep in mind this concentration problem could get worse before it gets better, meaning that we see something where it falls back more into historical norms, okay? All right, this is a great chart by Bank of America, right? And what they did was they combined tech, discretionary communications, the digital economy, and then they compared it to the real economy, which would be industrials, financials, energy, and materials. And of course, there's a number of things we can take away from here. This is just really what this is showing is growth versus value, right? Growth being the digital, real economy being value. And we can see that, this has gotten up here around that sort of 50, 53% level in terms of the digital economy. And then the real economy has gotten down, at the lowest level. But keep in mind this is really important. Look at the digital economy. It has made a series of higher highs and for the most part, higher lows. That's an uptrend. The real economy has made a series of lower lows and lower highs. Okay, that's the definition of a downtrend. So we have to keep in mind that there's a change in character in terms of the S&P 500, in terms of what is driving, the performance and what is driving breadth. Now, another important thing to recognize, look, between 1925 and 1955, the real economy bounced between, let's call it 60% and maybe 45%. It's hard to see on here with these levels. The digital economy bounced, between 30 and 10 or 12 or something like that. What happens if this relationship switches and the digital economy does what the real economy did back between 25 and 55, meaning we bounce between, say we go to 60% and then we correct, we go back down to 35, 40%. So this whole relationship shifts, right? Because what we know over time is the economy in the United States has shifted from an industrial economy to more a service and digital-based economy, okay? This is very big picture. Nobody knows whether it'll happen or not. Even if we do, say, bump up against 60% in terms of the digital economy weighting, we know there will be some big major crash that occurs, right? Nothing ever goes to the sky forever, and it'll fall back. But just something to keep in mind in terms of whether this may persist. And if it does persist, are you positioned properly for it, okay? All right, here's another great chart by Visual Capitalist that Callum Thomas shared on Twitter. And this just goes back to this whole growth versus value, digital versus real. This shows tangible assets versus intangible assets. Tangible, right, would be the asset heavy or the value sectors. And then sort of intangible would be the growth or the asset light, right? Intangible would be things like buildings and equipment, right? Inventory, land. And then when you look at intangible, you're talking about things like patents, brand value, customer data, right? Software, all that stuff. In the S&P 500, right? Look at the shift. It's now down to where 90% of the S&P 500 is intangible assets versus back in 1975, it was like it was 83%. Okay, so you had this structural shift within the S&P 500 that, it's very important to be aware of. Okay. All right. Now, is it justified? Well, Callum also, who runs top-down charts, shared this wonderful chart here, and this looks at all U.S. tech stocks and compares those earnings to U.S. non-tech stocks, okay? And what you can see is the tech stocks earnings have, been pretty darn good. It's the line is moving from the lower left to the upper right. But what you can see with the non-tech stocks or that real economy, here they peaked in like roughly 21, right? Fall of 21, and they've been sort of moving sideways to slightly down. Okay, so this big bump up in tech, right, has been somewhat justified by earnings. Now, whether valuations are justifiable, that's a whole nother story, but it's been powered by earnings. Okay, let's look at Mag 7. Same thing here, trailing 12-month earnings per share. Well, it's moving lower left to upper right, and we've seen just this massive move here, in the last couple of years. Okay, you had the correction during COVID, and then boom, it takes back off. This performance, this outperformance by tech, has been justified by earnings moving up. Okay, a lot of discussion about the U.S. versus the rest of the world. Here's a great chart by Kaeppel, and what you can see, the rest of the world, like, it's been moving down. In fact, it looks like it made a new low here just recently, whereas USA has been moving up. So, you hear a lot of people, talk, and they say, well, you need to be diversified across the globe. And from a big allocation perspective, I think it's wrong if you're just buying the globe. Now, if you're, hire a manager or you're doing single stock research, of course you're going to find stocks that are going to work. But if you're just allocating to something like, the MSCI World ex-USA ETF, and you've been underperforming, well, here's a big reason why. It hasn't been justified by earnings, per se. Okay? All right, so that's just sort of the big picture in terms of what's going on. Let's also just touch on the Russell 2000. There's been a lot written about the Russell 2000, why it's going to perform, when are small caps going to outperform. And what we've seen here is just really a structural change in terms, if you look at this index as a whole, you can see that the percentage of companies with negative earnings has just been moving from the lower left to the upper right. You're in sort of this low 40% range. If we ever do get a recession, imagine what's going to happen to the Russell 2000 stocks in a recession. If they're already at 40% with negative earnings, imagine what's going to happen in a recession. And this just goes back to sort of the big picture. There was this Financial Times article that I recently, read, and there's been a lot of, academic research on this subject in terms of how only really a handful of stocks over history have been responsible for, performance. And this was a great stat here. I'm just going to read this. In fact, only 2.4% of 64,000 public companies listed across the world account for all of the 76 trillion of net global stock market wealth created between 1990 and 2020. Okay, let that sink in, right? There's a very small percentage of stocks that really account for all the performance. It's really important to know, what you own, whether it's domestically or globally. This has, profound effects. Okay. All right. So moving forward. All right. So we've got this high concentration. We know it's creating these breadth distortions. It's creating attribution problems in terms of performance. Everybody sort of wants to put their 2 cents worth on, whether this is the dot-com bubble or maybe this is something like the Nifty 50. Walter Deemer, very esteemed analyst who worked for Merrill Lynch for a number of years, was around in the 60s and 70s, so very familiar with the Nifty 50 area. Walter put out a tweet not too long ago, just sort of commenting on, his perspective. Don't rule out that what we are currently seeing is maybe something similar to the Nifty 50 era, which is in the late 60s and early 70s. And so, of course, being the AI era, I just went to ChatGPT and, typed in, tell me about the Nifty 50 era, and it popped up this slide here on the right. Of course, what we can see here is things like Polaroid at 90 times earnings, McDonald's at 85, Coca-Cola 46, IBM 40. And then what happened? Well, everybody thought that these stocks would never go down. And then the 1973-74 bear market hit, and Polaroid dropped 90%, McDonald's dropped 70, Coke dropped 50, IBM dropped 60. Nothing goes to the sky forever. Okay. But I did highlight here, you can look at Microsoft, the top 7 here, the Mag 7, you can see their forward PE and their trailing PE. And of course, Tesla is obviously very expensive, but some of the other ones aren't nearly as expensive as, say, a Polaroid was during the Nifty 50 era, or McDonald's. So if this is the Nifty 50 era, I think I don't think we're near the end. Okay. Who knows where we are, but it certainly doesn't seem like we're towards the end. If this is like the .com era, I don't think we're towards the end. Okay. I think we're still early stages, meaning we're in that land grab, right? Everybody's buying chips. Everybody is building and investing in data centers, right? We just heard Microsoft's going to spend $80 billion this year on data centers, right? And then we see that companies are securing power sources. So that's just sort of the early land grab that we're in. And then down the road, we'll probably get all these great consumer products and whatever else that, and that's where you run into the danger, right? If you compare it to the 2000.com, everybody went to the land grab, right? And remember, we laid enough fiber optic cable to go around the world 1 million times. And then what happened was, well, we didn't need it. Okay. And then we had the bust. Okay. So whether, we're in the first third, the last third, who knows? But it doesn't seem like we're in the last third here in terms of a .com comparison. Okay. Again, that's my subjective 2 cents worth. You may have a different point of view. Jay may have a different point of view. That's what makes markets. Okay. So what am I watching right now? What are sort of the most pressing issues? Well, the 10-year Treasury yield, which I put out a note on Monday. I'm looking at the dollar index, and then I'm looking at inflation. Okay, these are sort of the first two, Treasury, 10-year Treasury yield, the dollar. Those are really kind of what's been sort of dictating this consolidation here of the last 4 to 6 weeks. And then of course inflation is something that we just need to keep an eye on. So let's take a look at a couple items here. I put this in my note on Monday. We've had a big move up here. I think we've gone up maybe 115, 120 basis points since September in the 10-year. And, across the curve, everything from 2 to 10 years is moving up. You can see that they all have made a 3-month high. All but one has made a 6-month high. And then, of course, the 12-month high, 20%, that's the 10-year. And the danger for the market right here would be a sustained breakout above that sort of 5% level in the 10-year bond. That to me would get us from what is right now a consolidation, right? We haven't gone down more than 5%, so we call it a consolidation, even though under the surface there's been an extreme amount of damage done. That's what would get us to me where I think we probably have that 10% correction, which, as I mentioned in my note on Monday, from August 23 to sort of October of 23, that was the last time we had a signal where the 10-year bumped up to that 5%, and that's what got us that 10% correction. Everybody freaked out about yields. That's what we're dealing with right now, is this yields. Now, again, we got the CPI out today. Last I checked, bond yields were falling. Stocks rallied. If we fall back down here, in the 10-year to 450, it probably keeps a bid under the market. But this is probably a story down the road here, right? And what could happen is we could see yields sort of pull back, stocks, maybe we go back up to the old highs. But we want to keep an eye on this for a breakout above 5% at some point this year, and a sustained breakout. I think that would probably cause some more problems for the stock market. This is just a great big picture chart, but you know what we can see here is this is the 10-year yield. It's a monthly chart, and what we've seen now is 37 consecutive months where the 10-year yield has been in the upper half of its 3-year range. If you look at how many months it's been in just in the upper upper third of its range, it's at 34. Okay. And so what this shows you is we have a change in character in terms of interest rates. We haven't seen this persistently high level on the 10-year since, back in 1980, right? And then you see these other instances too in 65, 70, 76. So what I did was I just draw a line here. The black line there just shows you every time we've reached 37 months where we've been in the upper half of the 10-year, 3-year range. And what you can see is these are all associated with bear markets or corrections, okay? Some of them were in the midst of the bear market when it occurred. Others like 76 and 80 occurred as, stocks were topping out. So this is something big picture we need to keep in mind, on a go-forward basis. And another point I would make is when all this occurred, this was back in the 65, 70, 75, 80. This was in a rising rate environment. This is when the real economy stocks were the dominant stocks in the S&P 500. Okay. If you look at history, we also know that, we used to have more frequent recessions. Now we have less frequent recessions, right? As we've transitioned, from the real economy stocks, which are more impacted by the business cycle, to more of these digital economy stocks, which are less impacted by the business cycle. It doesn't mean they can't have a bear market. It just means they're less impacted by, by the business cycle, and we're having fewer recessions. We just need to keep in mind, well, will this pattern hold? Will we get this bear market and recession sort of environment like we had back in the 60s, 70s, and into, the ADP, right? This was all during a secular bear market period, right? We're in a secular bull market period right now. So something to consider, a lot of different, outcomes here. Okay. The other sort of thing I'm watching here is the dollar. Okay. And what I've found, just, running studies going back to 1971, is that the 126-day rate of change for the dollar index is when it starts to get to 8%, that's when you have problems for the S&P 500. And you can see in this little table here, above 8%, the S&P 500 annualizes at negative 1.4%. Above 9%, it goes to negative 2.5%. And then you get above 10%, and you're talking about a negative 13, almost 14% annualized return for the S&P 500. So we're not there yet. Right now we're at 4.69%. I think the dollar index is backing off today. And the dollar index bottom, around the same time as rates, right, back in September. So if you think forward 6 months, this could be a problem as we get into sort of March, if the dollar index stays up here or even goes higher. We need to keep an eye on the dollar. Another important factor along with interest rates. And you can see here, there's been a lot of comparisons. You've seen guys mentioning Trump 1.0 and how the dollar rallied after the election, and then it, rolled over. And so for me, I just used a simple little system. If the 126-day rate of change for the dollar index goes above 10%, the model says, sell the S&P 500. And what you can see is it actually gave a sell signal, after Trump 1.0 in, sort of December of 2016. You got about a 1-month consolidation, and then the dollar backed off. So don't rule out that, maybe rates and the dollar back off here, and this consolidation resolves itself by stocks moving higher. What does that mean when you see this 10% increase in the dollar index? Well, here you can see for the S&P 500 and for the various sectors that, over the next 6 months, well, really 3 months, you have a lot of negative returns. 6 months, you're just lackluster. And then about a year later, the S&P is up around 8%, which is generally speaking about what you normally get, on an annualized basis over time. So it does impact stocks in specific sectors. So we need to keep an eye on that 6-month rate of change for the dollar index here on a go-forward basis to see if that gets up above 10%. All right, let's talk about inflation. Of course, we had CPI come out this morning, and this is just an inflation model that I use. The concept is courtesy of Ned Davis Research. But basically what it does is it looks at year-over-year CPI and compares year-over-year CPI to its 8-month smoothing. And when we see it, the year-over-year CPI rise 1% above its 8-month smoothing, you get a sell signal. When it falls back below zero, you get a buy signal. Okay, well, what does that mean? Well, when CPI is favorable or you're on a buy signal, the S&P goes up 10.8%. When CPI is unfavorable or negative, the S&P analyzes it at -4%. Okay. This does not reflect today's numbers. So again, we popped from 2.7% on a year-over-year basis to 2.9 on CPI. This is now turned positive. So this deviation calculation went from -15 basis points to now +11 basis points. We need to get up to 1% in order to trigger a sell signal. And even when we do trigger a sell signal, it can be a little early. If you look at the last one that triggered, I believe that was sort of like springish of 2021 when that triggered, and then the stocks didn't peak until January. But what we did start to see is breadth start to deteriorate, in the spring, and more so into the fall of 2021. And then, of course, the stock market peaked, I think January 3rd. So, Jay, do you want to make a comment real quick in terms of inflation? Because I know that's one of your things that you follow.
Yeah, so another very simple approach that I use, that I've written about in the past, is that 12-month rate of change in the CPI. Really anything between +4% and -3%, I consider it moderate inflation, and the stock market historically has done very well. It's when it gets outside of that range, above 4%, too much inflation, or below -3%, which is too much deflation, which we haven't had to worry about in a long time. But when either of those things happen, then inflation is worrisome. Right now, inflation to me is it's an important factor for the stock market, but right now, in my opinion, it's not really influencing the market, except today people like the number because it wasn't too high. So that's kind of where I stand on inflation.
Yeah. So, yeah, I mean, it's a big topic. Everybody thinks we're going to have this resurgence, and maybe we do, maybe we don't.
If I can say one more thing, Dean, my
Sure.
advice to most people is ignore most of the blather that goes on about inflation this, inflation that. Take a look at this chart that Dean has on the screen. And like I said, I have an article. I can't remember when it was. It was a while ago. But as long as it's between +4 and -3, avoid all the deep, dark implications that people talk about.
Yeah. I do think, the noise will get louder. I mean, if we see year-over-year CPI creep up, 3.2, 3.5, right? What's going to happen is you're going to have this recency bias. And everybody's going to be like, oh my God, remember what happened in 2022 when inflation spiked and stocks got crushed? And so you will have this sort of recency bias that will probably create a lot of noise in the marketplace because people just don't want to get caught flat-footed, have to explain, well, we weren't prepared for this resurgence in inflation. It may happen, it may not, so just something to keep in mind. Okay. All right. Well, so I put out a note in December on my financial conditions index triggering, a sell signal. This is influenced by what's going on with interest rates, exchange rates, valuations, and what have you. So I'm keeping a close eye on this. The financial conditions index has crept up to, like a 9-month high here. So it's something to consider. If everything backs off, then this thing will probably trigger a buy signal, and maybe we get another up leg in the market, break out to the upside. But it's something to consider here. Okay. All right. Well, just a quick update on the I put out a note not too long ago. Actually, I think it was the end of the year on energy. Got an extremely oversold, and we got this breadth reversal signal. And so far, just through yesterday's close, energy's up 5% over that same time frame. The S&P down 44 basis points. And what I want to just reiterate is, and what I said in the note is, this was a trade. Okay, it was not an investment, and this continues to creep higher here. So if you were in this for a trade, trail a stop, use something maybe like a 21-day moving average as a stop or something, and just ride it while it lasts. Crude oil continues to move up, which has obviously helped this trade, and that's something to consider here. For CPI and inflation going forward. If crude moves up, which I don't know whether it will or not, but if we break above 80. That's going to get all the inflationists, screaming again. This was a scenario where it was extremely oversold and looked like a good opportunity. And I do want to highlight that the materials sector triggered a breadth reversal signal yesterday onto the close. When I looked at it, it had decent results when you just looked at it as a standalone. But when I narrowed it down, I said, well, and I used the same parameters as the energy trade, meaning the S&P 500 was above its 200-day moving average. Materials were below, because that's the current conditions. When you did that, you got mixed results. Okay, so I'm probably not going to put a note on it, because if it's not compelling, I don't want to put a note on it. But just be mindful that materials could revert higher as well. I know Jay put out a note not too long ago showing a number of oversold conditions suggesting it should bounce. If you look at the chart here, from a trade perspective, these more recent signals have done pretty well. So anyway, just keep that in mind. Materials could work higher here. There's a lot of groups within materials. I mean, specialty chemicals, just have gotten destroyed. When I looked at specialty chemicals not too long ago, look back over a 2-month period, like they had hit something like 21 42-day lows. And if you go back all the way to like 1960, they had only done that one other time, and that was in 1998 when you were in the throes of the LTCM, correction. So very extreme relative oversold condition in specialty chemicals, which are stocks in the materials sector. So, all right, I think what we're going to do here is we're going to flip over to the website and just review a couple things, other things that I wanted to touch on. So if you go to the reports page on the website, you can obviously review all the reports, and then you can see our forecast / recommendations. And what I have queued up here is all the recommendations that I've made over just the last couple of years. And so what I wanted to do is just sort of address this. Green is a bullish recommendation, red dot is a bearish recommendation. And generally, whether it's Jason, Jay, myself, whatever, when we're putting a bullish recommendation on the S&P 500, what we're doing is confirming the trend. So if we're in an uptrend like we have been, right, and you see a bullish recommendation, what that means is we're just giving you evidence to suggest that that bullish trend should continue. If we put a bearish recommendation on something, then what we're doing is just saying, hey, here's something that might suggest the uptrend may not continue, you know, or it's not confirming what is going on with the uptrend. And so what just to sort of zoom in here is, you know, the last bullish recommendation, you know, that I put out for the S&P 500 was on November the 8th. Well, why? Well, because I wasn't finding a lot of compelling evidence to support a continuation of the rally. We only want to do something if there's that Z-score is, you know, 2 or above or close to 2. I wasn't finding a lot. You know, the market had been up a bunch, and so I just didn't want to put out any recommendations. So you didn't see anything. You know, I published notes. I wasn't putting a bullish recommendation on. And what you can see then, the S&P 500 peaked on December the 6th, and then I got that risk warning model signal where we saw a greater, you know, 8% of the issues in the S&P 500 triggered a 52-week low, and you can see that little red dot right there. And, you know, that was just me saying, hey, this is not confirming the uptrend. You know, we've got too many lows that are triggering here. And what you can see since that's happened is I still haven't made any bullish recommendations, okay? So my view is just sort of a neutral, I'm holding. You know, if I have a stock or if I have an ETF where I lose that relative strength or I lose that trend strength, and we've added those trend and relative trend scores to the website, you know, if one of my stocks or ETFs triggers a sell signal, I will sell it, okay? And then I have a decision. Well, do I go to cash, or, you know, do I just put it into a proxy like the S&P 500? Now, on a go-forward basis, right, you know, we're in this consolidation. We've seen some deep oversold conditions in certain sectors, and we could be setting up for another advance higher. And if that occurs, I suspect, you know, Jason, myself will start getting bullish signals, and I'll start putting recommendations back on S&P 500, confirming the uptrend. So that's where we sort of just stand, is just, you know, sort of neutral to hold what I own. And if I see compelling evidence start to emerge here, breadth thrust, trend signals, what have you, you know, reversals, then, you know, you'll start to see these green dots start to appear on the recommendation chart. Okay. All right, let's take a look real quick at the strategies, just so that we can get sort of an idea of what is going on in terms of the market. We just sort of sort our sector page. What we can see here is that currently, based purely upon relative strength, this timing model that we put on the site, we're long consumer discretionary, we're long financials, we're long communications, and we're long tech, okay? That's a pro-growth bias there in terms of what, you know, relative strength is telling us, with the obviously exception of financials. But there are plenty of financials that have looked good. The breadth within financials looks good. We have this sort of pro-growth sector backdrop. You know, if we look at the factors, you know, and what we can see here is, you know, we can also see that, you know, large cap growth is on a buy signal over large cap value. Small cap growth is on a buy signal over small cap value. And then mid cap growth on a buy signal over mid cap value. If we look at our indexes, NASDAQ's on a buy signal versus the S&P 500. The NASDAQ 100 is on a buy signal versus the S&P 500. So a pro-growth backdrop in terms of what we're seeing in terms of relative strength, okay? This value versus growth, digital versus real economy. And it's not to say that we don't get a bid here in the real economy stocks should interest rates ease back, the dollar eases back, you know, that stuff's all going to rally. What this really is just, telling us is that we've had this sort of, which I've been talking about, for months, is just sort of this internal sector rotation where one group takes over, another one lags, then that lagging group takes over, and then the leading group lags for a little bit, right? And that's it's really giving us these breadth distortions, these breadth oddities, this performance distortions or oddities. But as it stands right now, we need to, the weight of the evidence continues to suggest growth/digital economy. And so we need to stay the course there. And then if we are holding other stuff, like, again, you can make plenty of money in the financials. There's plenty of stocks in the financials that, that look, good and compelling. So Jay, you want to add any 2 cents worth on sectors or, your thoughts here?
Sure. So first off, terrific charts in this presentation, really made things crystal clear. Throughout this whole presentation, the thought I keep coming back to is one of my favorite sayings, which is follow the trend, but do not fall in love with the trend. And you think about it, if an investor had ignored US large cap growth stocks over the last 5 years or more, how vastly they underperformed the market. It emphasizes the importance of trend following. However, some of those early charts that you showed kind of, I don't want to say they scared me a little, but we know how the Nifty 50 ended. We know how the NASDAQ fell apart starting in 2000. And now we're looking at a similar concentration. My guess is at some point, this bull market will end much like those did, with some of the leaders now suffering huge declines. That's not a prediction. I'm not saying sell anything. I'm in follow the trend mode, but it's just so important to keep on top of that trend, but to also recognize when that trend changes, you have to take action to go a different course. So that's kind of what I took away from a lot of this today.
Yeah. Look, this is big picture. By no means am I suggesting that you should just be all in growth stocks, and set it and forget it. Like Jay said, follow the trend, follow the relative trend. When it tells you to get out, don't say this time is different. Okay. We know there will be a big correction. Again, my 2 cents worth is it that big.com or Nifty 50 thing, it's going to be accompanied by a recession, okay? What we saw in 2022 was, a big pullback in the tech stocks, right? Because they'd gotten sort of that upper end of valuation extreme, and they got hammered. You needed to be out of those. Nothing will go to the moon forever. When the time comes, these stocks are going to get crushed, just like they have throughout history. What I'm just suggesting is you need to understand structurally, the S&P 500 is much different today than when it was 10 years ago, 20 years ago. This concentration is something we'll have to deal with. We're more in a digital economy versus a real economy. And these are all just important things to consider when you're investing. One other thing I wanted to mention on the sector page, and this gets back to the whole concentration problem. So the XLK, right, has restrictions in terms of the weighting, right? This is an ETF, right? And so it underperformed the S&P 500 technology index, right? Because it can't own the same percentage of those highly weighted stocks, whether it's NVIDIA, Apple, and all that, right? It's a structural issue for XLK in terms of the maximum amount they can hold in an individual stock, okay? So what happened was, is if you just looked at XLK year to date in 2024 compared to the index, you're like, wait a minute, the index is, up, whatever, I'm just making numbers up, but the index is up 25%, XLK is only up 20. What's going on here? Well, XLK could not hold the same percentage as the index. So what did that do? Well, when you look at our strategies page, well, XLK, last year was only up 11.78%. So, and it didn't get a buy signal when another technology ETF, the VGT, the Vanguard Technology Index, did get a buy signal. And therefore, even performance last year for XLK versus VGT was, I mean, it was a huge difference, 18.4% versus 11.7%. So long story short, I decided, look, let's add VGT into the sector page for the strategies so that we might get something that might mirror the S&P 500 technology sector a little more closely. But I just wanted to make sure everyone was aware of that. If you were holding XLK last year, you underperformed the index. So just something to think about. Okay, let me see right here real quick. We might just go back over to the questions. Just want to make sure I check everything here. Yeah, let's do that. All right, so let's address some of the questions that subscribers pre-submitted. And the first one here, smart money and dumb money moving together lower over the past 2 months, very rare. What does it mean? So I reached out to Jason, and Jason provided, a great chart just to sort of give us some perspective on this. And I'm going to just shoot over there, and you can kind of see here. And I'm just going to kind of read what Jason provided. But the attached chart shows how many days over the past 2 months that both of them moved lower than they were 2 months ago. It's at a record high, but previous spikes didn't precede anything consistent. And so what Jason means by that is what you can see from like sort of 98 to 2009, when it did spike higher, the market, generally went down. But post 2009, when you see this spike higher, the market moved higher. Okay. So that's what Jason means, that there wasn't anything consistent. It used to have a negative message. Now it's more so likely to be a positive message. So it's just inconsistent. So I wouldn't make too much of it. Okay. What are your thoughts on the Hindenburg omen that seems to have triggered in late December 2024? Jay, you want to touch on this one?
Yes, I have a couple of indicators that are going to be added at some point that will kind of address this a little more closely. Combines the Titanic syndrome indicator with the Hindenburg omen, and basically just the more of those signals you get, the more negative the implication for stocks going forward. For the NYSE, it's not really an issue. The NASDAQ indicator that I'm working on gave what is considered an unfavorable signal during that December timeframe. But it's only one indicator. I don't call it a sell signal, but it basically, what it tells us is there's starting to be some churning in the market. Just basically means fewer stocks going up in a bull market, and that sometimes gets hidden by the index action. So it's slightly unfavorable at the moment, but I wouldn't make too much of it at this time.
Right, and again, we saw that in my TCTM risk warning model, we had that spike in new lows, again, that model looks, a lot of components in there are related to new lows. I've expressed this before. I think that's the most important indicator to look at in a bull market is 52-week lows. Relating to that risk warning model, the count is just 10%. We have to get 50% to get a signal. Some of them were pretty close here recently. So that's, what I've sort of said is I want to keep an eye on that. Should we advance here and make new highs and not see strong participation, and then say maybe we fall back into the consolidation, that's when we want to sort of keep an eye on 52-week lows. We want to keep on what Jay's saying, these Hindenburgs or Titanic syndromes, churning, new lows expanding. That's when a problem will, occur. Most likely, if that problem does occur, it probably means that 10-year yield is up above 5%, and that's a concern to investors. All right, question 3, what tools and indicators are most useful for swing trading or holding for a few months? Well, we just added the trend score and relative trend score indicators to the website. For me, those are what I use for sort of holding for a few months, right? You want to see the trend and relative trend scores, or whether it's a stock or an ETF, both move up to 8 or higher simultaneously, right? That gives you sort of that backdrop of, this stock is in an uptrend, and not only is it an uptrend, but it's outperforming in the uptrend. Okay. In terms of the more swing trading type of signals, use the net change, right? So we have the 5-day net change on the trend score that you can look at. And generally speaking, when you see the trend score on a week over week basis rise by 4, 5, 6 points, those are good swing trading opportunities. As I said in our webinar, when we introduced these tools, trend following works when stocks trend. When they move sideways in consolidation, it doesn't work. You get lots of whipsaws. So it's very important that you have a pool of stocks, right, that trend, right? And so a lot of times, what I'll do, or you see other professional traders, retail traders, is they'll create a screen, okay, and they'll say, all right, look, we want to only find stocks that have 500,000 shares per day on average, trade 500,000 shares per day. We want to see an average daily range of 2% or greater, okay? We want to have stocks that are over a certain price level, right? Because they have bigger swings. So you narrow down, you find a pool of stocks. You can throw fundamentals in there. You can say, well, we want to see stocks that have, year over year revenue growing at 20% or more, 30% or more for, say, back-to-back quarters or something. And you find these stocks in this pool, and then you apply these trend and relative trend indicators to it. All right, question 4, are there indications that the weak small caps will join the bull market? Are there are there indications of dollar trend change? Well, we did address small caps. 40% or more of the stocks in the IWM or Russell 2000 don't make money. So my personal opinion is you don't buy small caps as a allocation to your portfolio, like, for instance, the IWM ETF, until we get a bear market that's accompanied by a recession, right? And that's when small caps tend to outperform the most, is coming out of those recessionary periods that are accompanied in a bear market. And you see them outperform in a big way. That doesn't mean there aren't plenty of small cap stocks that you can't buy that will outperform the S&P 500 or other indexes. But I think that's just a single stock basis that you need to be looking at, not just small caps as just a general allocation to IWM in your portfolio. Again, if you just look at the chart, it just looks broken. It's just very choppy, sideways. It doesn't trend, and that's because of all the junk in there. And are there indications of the dollar trend change? I'm not seeing anything. It's in an uptrend. Again, what I think will happen here is if rates back off, the dollar will back off. They're sort of glued at the hip here, but I'm not seeing anything. Jay, anything you want to add on this too?
Yeah. So for the dollar, I wrote a piece recently about the dollar. I follow a couple of cycles on that, and this is like the first year one of what I call an 8-year cycle. Okay, so after the first couple months of the year, January and February, tend to be bullish for the dollar. And so far, so good. And then it gets choppier generally after that. In year one, historically, the first 2 years are great. And then after that, it weakens considerably. So I'm not predicting anything, but what I'm watching very closely is for the dollar to continue to rally into late February. After that, if it peaks and starts to trend down, I'm going to consider that as a significant top in the dollar. Again, that's not a prediction. It's what I'm looking to see, because a change in the dollar trend will have a lot of important implications for stocks and especially for commodities.
All right. 5, probability of a cyclical bull market peak in mid 25 for SPX.
Can I jump in here?
Sure. Go ahead, Jay.
Sure. So in late September, I wrote a piece about what I call the mid-decade bulge, which is basically the last 3 months of year 4, so October, November, December of 24, all of year 5, and the first 3 months of year 6. That 18-month period has been historically a phenomenal period for stocks. That doesn't mean that stocks are necessarily going to rally strongly through March of 2026. But what it does for me is it tells me to continue to give the bullish case the benefit of the doubt, unless there is some kind of serious breakdown in actual price action.
Yeah. Look, I think, look, we just have to take it one day at a time, continue to monitor, all the indicators that, we've talked about in this webinar, as well as Jay's last webinar, and just, look at the weight of the evidence. And, if that weight of the evidence shifts from bullish to bearish, you could have a cyclical peak in stocks in 25, 26, whenever it occurs. Okay. How have emerging markets performed after such a period of rapid increase in the U.S. dollar? Well, again, it's very similar to that table I showed you, with the S&P 500 and sectors. Emerging markets don't do well. Generally, just speaking, stocks don't do well when you see a big rapid increase like that in that 126-day rate of change. So, Jay, anything there?
Well, emerging markets and the US dollar do have an inverse relationship. So right now, with emerging markets looking terrible relative to large cap stocks and US stocks, and the dollar trending higher, that's a bad environment. So again, that's one of the reasons I'm keeping a close eye on the dollar. If it starts to fall later in the year, that may improve the outlook for emerging markets. But they still have a lot of work to do relative to everything else, the S&P, et cetera.
Okay. All right. And then finally, based on what sectors looked attractive for the first half of 2025? Well, we addressed that just when we talked about the strategies that are on buy signals. Again, it still favors the sort of digital economy growth / stocks and sectors. And so we'll just need to continue to sort of monitor that on a go-forward basis.
Yeah, so something I'm keeping an eye on, you mentioned energy stocks. They're kind of a potential sleeping giant at the moment. They tend to trend well in the first half of the year, and they're doing well right now. So that's definitely one to keep an eye on. And then I have a piece coming out tomorrow. I wrote one last week about when the yield curve uninverts, when it goes from negative to positive, and how the S&P tends to be, it's got a mixed history when that happens. But in the piece coming out tomorrow, I look at the 11 S&P 500 sectors, and I was, I guess, not surprised, but a little surprised to learn that defensive stocks, particularly consumer staples and healthcare, were by far really the top performers during the 12 months after the yield curve uninverts, which it did in December. As always, that's not a prediction that those are going to be the top 2 performers over 2025, but I think they could start to surprise people if they can pick up some relative strength. And one last note, I noticed that Jason put out a piece this morning on consumer staples. So you definitely want to take a look at that.
Okay. I think that's a wrap. We're a little bit over an hour here. I just wanted to remind everyone that our next webinar will be February the 19th, 11 a.m. Eastern Time. Jay will be the featured speaker, and I'll be the guest. So we hope you can join us then. If you have any questions, follow-up questions, just send those to admin@SentimentTrader.com, and we'll do our best to get those back to you. And I just want to thank everyone for being here today.
Yep. Thank you for joining us.